In this week's video, we'll review the latest technical and fundamental data that demonstrate the bulls have setups in place for a monster breakout. We've got a lot to cover, so we'll be moving quickly. Feel free to use the pause button on your video player. In late September 2019, are there things to be concerned about relative to the stock market? Absolutely, positively, yes. But we can say that 365 days a year. Our job is to monitor the weight of the evidence. It's very, very easy to fall into the what about this trap. As we've covered in the past, common sense tells us if a lot of people get fired from their jobs, the probability of bad things happening will start to increase. Our concerns would increase in the next few weeks if the unemployment rate spiked up to over 4% and more specifically to 4.13%. Once again this week, we have not seen a big spike in weekly unemployment claims. In fact, the 4-week moving average for claims fell by 750. Therefore, based on what we know today, it doesn't seem likely or highly likely that we will see a spike on this chart when the new monthly data is released in a few weeks. The labor market still looks strong. What about the Fed? From this week's press conference, Powell, we are going to use the tools we have, and if it comes to it, we are going to use all of them. We are prepared to be aggressive. Powell says it's possible the Fed will resume balance sheet growth. Unlike recent press conferences, the market rallied after this week's press conference. And you can make an argument that these statements here inside of the blue box are somewhat similar to Mario Draghi's "we'll do whatever it takes" comments a few years ago. In this case, Draghi was talking about saving the euro. In this case, we're talking about potentially avoiding a recession. And we know, history tells us, the backing from central bankers can be very, very important. In this case, what happened after Draghi said, "we'll do whatever it takes"? The answer is really, really good things. "We'll do whatever it takes" comes in this area here. We break out of this long-term consolidation box. From this point to this point, the S&P 500 tacked on over 50% and rallied for over 2 years. Clients and regular viewers know that we make probabilistic statements in these videos based on the facts that we have in hand today. No forecasting. These are monthly charts of the S&P 500. This is the exponential 8-month moving average in blue, the 9-month EMA in red. This is the rollover look in the present day that we would like to avoid. One of the first things we don't want to see is blue turning down with a negative slope and starting to close the white space between blue and red. Totally different situation over here fundamentally. Look how similar the rollover looks on the charts. Thus, in the present day, we want to avoid this look here. How does the exact same chart look today? Better, worse, or about the same? The answer is much, much better. Both moving averages are posting new all-time highs. The space between blue and red is increasing, not decreasing, and the slopes of both moving averages are up, which is in stark contrast to this look here and this look here. Instead of having a breakdown look, we have somewhat of a consolidation and breakout look. This chart shows monthly PE multiples for the S&P 500 index. This is 2017. This is the present day on the right side of your chart. In the present day, 8 out of the last 9 months, we have seen multiple expansion, telling us, for the most part, that institutions have been willing to pay more for a dollar's worth of earnings. And we know that the past activity of some traders may tell us a lot about the future activity of other traders. Dating back to 1950, How many cycles like this have we seen, and what happened next in the stock market? The answer is we've seen something like this 11 previous times. Looking out 2 years, over 90% of these cases posted positive returns. The one exception, basically flat, a loss of less than 2%. The average gain was over 18%, and the median gain was roughly 16%. In markets, and from last week's video, we know that we have early adopters and late adopters. We have leaders and we have followers. Historically, when we see this type of action looking backwards from a set of some traders, it tells us something about the future activity, possibly of other traders. This doesn't predict what's going to happen next in the present day. It simply speaks to probabilities and provides some historical context relative to something that we've just seen. Now we're looking at the same PE chart dating back to 1950. In the present day, we are below the 50-month moving average. And as you can see in these two green boxes, it is not unusual for the market and PEs to stay above the 50-month moving average for a long period of time. Thus, in the future, it wouldn't be shocking if this chart morphed from a look like this to a look more like this, this, or this. A lot of similarities between the present day and the low in 2016. You can see, in that case, we had multiple expansion. Let's assume that earnings stay constant. Our present day PE is at 22.14. At the peak in 2018, we were over 26. Peak in 1999, instead of being willing to pay $22 for $1 worth of earnings, investors were willing to pay $35 for $1 worth of earnings. 1992, we peaked out just above 26. Thus, if multiples in the present day moved from 22.14 to over 26, that would be roughly a 19% gain. Earnings could stay constant theoretically, and the S&P 500 could move, just based on multiple expansion, from roughly 3,000 to over 3,500. If we saw multiple expansion all the way up to this level here, that's 60% higher. Back to this level here, roughly 18% higher. The average of these three numbers is 32%, and hypothetically that would imply the S&P 500 making it almost to 4,000. How is it possible that the market in the present day might be more optimistic than it was at this point here in 2018? Here's one scenario. US and China come to some type of agreement. Number two, a Republican wins the White House, avoiding a Democratic presidency. In that instance, it would be very, very easy to imagine that multiples could move above 22 to somewhere into this range here. You may say, well, the yield curve just inverted. No way are we going to see gains like this. Actually, better than expected gains aligns very, very well with yield curve inversion and history. This is one of the breadth thrust studies that we covered in last week's video. Most of the studies that we did last week were related to the 200-day moving average or the 200-day exponential moving average on either the NASDAQ, NYSE, or S&P 500. In last week's video, the dates that we identified historically were similar to what we saw on April 12th of this year. And in these cases, really good things happen looking out 1 to 4 years. Do we have anything in the present day that ties the breadth thrust thesis to a point in time closer to September of 2019? The answer is yes. Now we're looking at NYSE, the percent of issues making new highs. Here's the indicator here. This is 1980. On the left side of your screen, this is the S&P 500 here. We just had something happen that is extremely rare. Low here, down near the green line in 2018, then we made it all the way back to the upper green line in calendar year 2019. If you know your market history, you know something that looks similar to 1981, 1984, 1987, 1990, 2009, 2011, and or 2015 is probably a positive development. Therefore, it might be helpful to know, how did the stock market do from this point here, this point here, this point here, and these 4 points here? The answer is extremely well. In every single case, the market was higher 1 year out, 2 years out, 3 years out, and 4 years out. And the important thing is, this study really ties us to the present day. These dates here are similar to something that we saw just a few weeks ago on August 2nd, 2019. Therefore, history tells us to keep an open mind about much better than expected outcomes walking forward from August 2nd, 2019. And that's exactly what happened historically when we walked forward from these dates here. 4 years out, average gain 62%, with 100% of the cases posting positive returns. The worst return was almost 40%. It's a pretty small sample size. Well, one of the ways that we combat that is with a weight of the evidence approach. Have we had any breath thrust type activity recently? The answer is absolutely positively yes. Similar concepts here. S&P 500 volume momentum oscillator. This is a thrust here. How are these thrusts helpful? Down here, this tells you that institutions, for the most part, are very, very pessimistic about the future. This thrust and rapid change tells you they have changed their mind. Institutions very pessimistic about the future down here. This thrust tells us they have changed their mind. This study's a little bit different. We're looking from a low, and then we're looking at each case after the low where we were able to get back to the blue line. There are 7 cases looking back to 2009 that are similar to this point here and this point here. It's also interesting to note, a lot of these breath thrusts come after a long-term period of consolidation. Consolidation box, thrusts here near the top of the box. We're near the top of the box again, similar thrust. In these cases, what happened next in the stock market? We can tell by looking at the graph here, good things happened. And if we look at the table, we see really, really good things happened. And the important thing here, we're not talking about a breath thrust that occurred or a signal that occurred in January of this year. This point right here, you can see this, we made it back to the blue line on September 13th, 2019. Historically, if we walked forward from similar points, stock market was positive 1 year out, 2 years out, 3 years out, and 4 years out in every single case, and the average gain ranged between 15% and 61%, simply telling us to keep an open mind about much better than expected outcomes going forward. Not a prediction, not a forecast. We'll continue to take it day by day. Well, this study only goes back to 2009, and you have a relatively small sample size. Okay, how about if we go all the way back to 1975 and increase the sample size? NYSE breath momentum oscillator, 1975 to 2019. The concepts are very, very similar. In the recent past, we came down to the lower green line and were able to make it back to the upper green line. It's only happened a handful of times, dating back to the mid-1970s. It's also noteworthy, we look like these periods here in the present day, getting back to this line here. We just did that in calendar year 2019. You can see that really doesn't look anything like the lead-up period to 1987. A lot of white space in here. Haven't hit this line in a long, long time when we peaked in the year 2000. Present day really doesn't look anything like this. Same thing can be said here in 2007. It's been quite some time, a number of years, since this indicator touched the upper green line. Not the case in the present day. We just touched it a few months ago. So not only does this chart tell us that the recent activity of some traders, this move from here to here, is similar to these dates shown in blue, it also tells us that the recent activity of some traders really doesn't look anything like this period, or this period. What happened next in the constructive periods? The answer is, again, really, really good things in most cases. Worst case scenario, the market was down roughly 8% 2 years out. But even in that case, you were up 7% 1 year out and up 13% 4 years out. Average gain looking out 4 years, 46%. 100% of the cases green 1 year out, 100% of the cases green 3 years out, 100% of the cases green 4 years out. We didn't arbitrarily pick these dates. This is something that happened in February of this year that is similar to something that happened in the mid-1970s, in the 80s, the 90s, between 2002 and 2003, after the low in 2009, after the low in 2011, and after the low in 2016. 2019 case, to be determined. We'll continue to take it day by day. Small sample size question is a fair question. If you're interested, you can pause your video player. Remember last week we covered the sentiment trader study about economic surprises. When something similar happened in the past, 100% of the cases the market was higher a year later with a median gain of 14%. Also noteworthy, Citigroup's Global Economic Surprise Index has risen above 0. It's the first time since April of last year. All of this tells us from a probability perspective, it's possible the economy has already started to turn in a positive manner. Remember, we covered this last week. Any signs that the trend is continuing? Yes, home sales came in above expectations this week. Last week, retail sales above expectations. This week, industrial production exceeded expectations. Why is the latest industrial production figure potentially significant? This is industrial production, 1995, left side of your screen, all the way up to roughly the end of 2017, early 2018. This is the type of look that we want to avoid. This is the type of look that we want to avoid. This is the type of look that we want to avoid. How does the exact same chart look today after the better than expected figure? It's possible industrial production is trying to make a stand at the Bollinger Band center line, allowing us to continue a look like this, a look like this, or a look like this, and potentially avoid a look like this, a look like this, and a look like this. Remember, we're talking about the facts that we have in hand. We're not making any assumptions about what happens with this chart next. Right now, we're above the center line. The center line is rising. The upper Bollinger Band is rising. The lower Bollinger Band is rising. That looks quite a bit different than this point here, or this point here. Really doesn't look anything like the upper Bollinger Band here. Doesn't really look anything like the upper Bollinger Band here. Simply speaks to probabilities. Yield curve speaks more so to future moves by the Fed. The yield curve has been telling the Fed, you're off base. The Fed is trying to catch up. What about the credit markets? A lot of talk this week about stress in the credit markets. Is it showing up in credit spreads? The answer is absolutely positively no. Credit spreads are better than they were last week at this time, 3.92. They narrowed to 3.82 as of Wednesday's close. In fact, they narrowed even more after Thursday's close. It's very, very difficult to say that we have a funding problem or stress in the credit markets when we have credit spread figures like 3.77 that are nowhere near these levels that we saw before big drops in the S&P 500. As we have mentioned in the past, these figures can change quickly. We're simply making comments about the facts that we have in hand today, not making any assumptions about what this figure will look like tomorrow. On Friday, September 20th, 2019, we are still way down here. How about the Chicago Fed National Financial Conditions Index? Here are the readings, facts that we had in hand before the S&P 500 dropped roughly 35 to 40%. The average reading, the one we don't want to see, 0.3. The median reading around the flat line, negative 0.08. Do we look anything like this or this in the present day? The answer is no. This figure looks a lot better than any of these figures here. We'll continue to take it day by day. Shaded areas show recessions. You can see the National Financial Conditions Index is well above zero before the recession. Well above zero before the recession. Starts to move here, gets above. Present day really doesn't look anything like that, telling us that financial conditions are much more favorable than they were up here or here. And it speaks to trust between parties, and it speaks to economic confidence. Here, you're not so sure people are going to pay you back. Here, you're relatively confident they will pay you back. Like credit spreads, these figures can change quickly. Simply making comments about the facts that we have today, not about what might happen tomorrow. Updating our 200-day moving average look from last week. This is the look we want to avoid. This is the look we want to avoid. This is the look of the chart on September 19th. Charts pretty much speak for themselves. September 19th looks a lot more like these favorable looks that we want to embrace. And if we fast forward one day to September 20th, price is above every single one of these moving averages. Blue is on top, and the slopes of all of them are positive. That is in stark contrast to the bearish looks that we want to avoid, where blue is on the bottom, the slopes are all down. This speaks to probabilities, and this speaks to probabilities. We still have a fluid and developing situation with China, and we still have potential resistance overhead. It is extremely important that we have realistic expectations about what happens in the short run, even if really good things happen in the long run. Like the other charts that we've covered, right now on September 20th, this chart looks constructive. Do we have any reason to believe we might get a bullish breakout? Yes, a study that you can find, Thomas Lee's Twitter feed. Here is the Twitter handle here. If you want to, you can just Google Twitter and this handle here, and you should be able to find the feed. They performed a study. When we have a 3% down day, which we recently had, and we have an inverted VIX term structure, which we also had, which is basically extreme fear and pessimism, good things tend to happen. The average gain, looking out 6 months, 15%, 96% of the historical cases identified in their study, positive. This is a screenshot from their video that you can find a link to in the Twitter feed. Another study in their video basically says when the Purchasing Managers Index is above 51 and we have extreme pessimism, as we recently did, The average 6-month gain, over 10%. Market was positive 75% of the time. Reading the Fed tea leaves in recent weeks said, wouldn't be shocking if they cut by 25 basis points this week, and that's exactly what they did. Ryan Dietrich's Twitter feed, here's his Twitter handle. If the first 2 cuts in a new cycle are 25 basis points, it's what we have. Last 5 cycles saw the S&P 500 up roughly 10% 6 months later and almost 17% a year later. Hard data saying we could be higher in 6 months. Hard data saying we could be higher in 6 months. Hard data saying we could be higher in 6 months. Well, if we're higher in 6 months, then we're in major breakout territory. And we know from past videos, the longer a market goes sideways, the bigger the move that we can expect to get. Back to Mr. Lee's Twitter feed. Nowhere markets. Pretty easy to understand what that means. Nowhere markets have resolved to the upside 3 out of 3 times since World War II. The average gain after a bullish breakout, 51% over the next 24 months. Hypothetically would imply the S&P 500 reaching 4,500. Well, that type of return sounds insane. Well, we could have said the same thing right here. That type of return sounds insane. This type of multiple expansion could have said the same thing here in 2015. That sounds insane. Even if we get back to these multiple levels here, stock market could rise if earnings are flat. That type of return sounds insane. The yield curve doesn't think it's so insane. The study that we just covered in this week's video seems to align with better than expected outcomes. In fact, this study that we covered this week is based on something that just happened on September 13th. And like this information here in this tweet, it tells us to keep an open mind about much better than expected outcomes going forward. Anything else that tells us to keep an open mind about a bullish breakout? Yes, sentiment is right where we want it to be. Comment here on Twitter relative to pessimism. Here's the Twitter handle. Another Twitter handle here for put call. Thought it was interesting when Kramer commented this morning that every single person he talked with at Delivering Alpha was bearish. Delivering Alpha is an institutional money management conference. Another sign that people are extremely pessimistic. Every single one of the top 5 most popular articles on MarketWatch this week, pessimistic in some way. If everyone at Delivering Alpha was bearish, that somewhat implies under-allocated. If you're bullish, would you be under-allocated? If you're bearish, logically, that would make sense. You would be more defensive. Any present-day hard data to back up that thesis? Absolutely, positively, yes. Equity exposure index, the level of equity exposure for professional money managers is basically identical in the present day, right here, to this point here, this point here, and this point here. Not coincidentally, all of those points came after consolidation boxes and breakouts. Consolidation, a breakout. Consolidation, a breakout. Pessimism tells us allocations may be too defensive, and pessimism tells us there may be some cash on the sidelines that could potentially propel the stock market higher. China remains the gigantic wild card, which is why it is extremely important for us to have realistic expectations about ongoing volatility, especially when we have potential overhead resistance here and we're still, for the most part, moving sideways. This is a blurb from the South China Morning Post dated September 19th. You can pause your video player. Another potentially positive development from September 20th. You can pause your video player. And part of having realistic expectations is understanding that they are negotiating. They're going to say and do what they need to do to try to get leverage. So the moral of the story is we have bullish setups. Setups require follow through. To summarize what we've covered, economic data may be turning. We have evidence of that. Possible something comes together for the U.S. and China. Market momentum looks like it's trying to turn back up. Powell basically said, we'll do what we need to do. Stocks have historically performed well after 2 rate cuts, similar to what we've just seen. The breadth thrust themes still intact. Thrusts speak to the institutional outlook. The previous action of some traders tells us something about the potential future action of other traders. And as we know, typically leaders lead in the market and followers follow. The weight of the evidence tells us that the leaders have done their part. This type of development here in this tweet is not what we would expect to see at a major top. This is a momentum is trying to turn tweet. The fluid situation with China tells us that we need to head into next week and every week with a flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.